Ladies and gentlemen, good day and welcome to the Quess Corp Q2 FY23 earnings conference call hosted by ICICI Securities. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Aditi Patil from ICICI Securities. Thank you and over to you, ma'am.
Thank you, Lizanne. Good day, everyone, and thank you for joining this call. From the company's leadership team, we have with us Mr. Guruprasad Srinivasan, Executive Director and Group CEO, Mr. Ravi Vishwanath, Group CFO, Mr. Kamal Pal Hoda, Group CFO Designate, Mr. Lohit Bhatia, President, Workforce Management, Mr. Pinaki Kar, President, Global Technology Solutions, and Mr. Sekhar Garisa, President, Emerging Businesses. Management would open the call with opening remarks, followed by a Q&A session. I would now like to hand it over to Girish Kumar Sharma, DGM Investor Relations, to take the call forward. Thank you and over to you, Girish.
Thanks, Aditi. Good morning, everyone, and thank you for joining our earnings call today. Please note that the results and presentations are already uploaded on our website. Anything we say which refers to our outlook for the future is a forward-looking statement and must be read in conjunction with the risks that the company faces. These uncertainties and risks are included, but not limited to, what we have already mentioned in the prospectus filed with SEBI. With that said, I will hand over the call to our Executive Director and Group CEO, Mr. Guruprasad Srinivasan. Over to you, sir.
Thank you, Girish. Thank you so much, and very good afternoon to all, and thanks for joining us today. Let me start briefly saying that it has been a terrific quarter from the growth perspective, as we crossed 500,000 by headcount on back of about 33,000 associates addition during the quarter. I'm happy the way our leadership teams are demonstrating their capability to stay ahead with the growth in this environment. The business environment for quarter was mixed. While BFSI and retail sector drove the headcount, there was a slowdown in IT which impacted our IT staffing and selection business. Our mature businesses have all contributed to demonstrate the growth, driving our consolidated revenues up by 32% year-on-year and 7% quarter-on-quarter. The consolidated EBITDA for the quarter was 135 crore, a 12% quarter-on-quarter drop. Following factors have contributed the same. First is impact of around 13 crore in IT staffing and selection business due to slowdown in IT hiring. Second, provision of 3 crore in training and skill development business to account the student dropout on ongoing projects. Increase in corporate expenses to extent of 5 crore. This is largely from higher salary cost, increased travel and spend on technology. Lastly, we have made a new investment around 4 crores towards building a staffing presence in the United States. This investment is in line with our long-term aspirational goal of achieving 6% EBITDA while maintaining 20% year-on-year growth. With estimated market size around 160 billion, US is the largest staffing market in the world. While this investment may have some margin impact in short term, we believe that this investment will open up new avenues and improve our margin profile of business in the long term. We firmly believe it's the best time to invest when there is a downturn. Ravi and I will be sharing more details on these cost matters during the course of the call. The headcount addition has been the best so far. We have added 33,000 associates by headcount in Q2, and we now deploy over 500,000 people across vertical and geographies. Please note, this number does not include an additional 21.6K associates who were payrolled in September but were not on rolls by end of the month. Cash generation continues to be strong with OCF to EBITDA conversion at 72%, consistent with our guidance. The sales engine continues to perform well, as evident with our headcount addition. We acquired 254 new customers in Q2. The sales engine continues to contribute significantly with 63 wins in our cross-sell in H1. Now coming specific to the platform updates, starting with workforce management. The platform posted a revenue growth of 7% quarter-on-quarter and 33% year-on-year. Headcount reached 376,000, an increase of 7% quarter-on-quarter and 27% year-on-year. General staffing headcount has crossed 333K with retail, manufacturing, BFSI being the key drivers. Driven by net addition of 25K by headcount in the quarter, general staffing grew by 8% quarter-on-quarter and 36% year-on-year. The margin profile, which we refer to PAPM, the PAPM gross margin profile stayed stable at 700 rupees. Value-added services in general staffing continues to contribute 19% of general staffing gross margin. Workforce management added over 100 new customers in the quarter, continuing 100 plus client addition streaks for over 6 quarters in a row. EBITDA from operations grew by 82% year-on-year and declined by 16% quarter-on-quarter. As outlined earlier, the major reason for EBITDA drops are as follows. Regarding the EBITDA drop of 13 crore due to slowdown in IT hiring, our IT staffing business saw a headcount decline of about 300 during the quarter. The slowdown in IT hiring has increased the cost pressure from clients, while the cost of acquiring a candidate has not gone down. In addition, this is the first time we have witnessed a delay in associate onboarding with the client. This has created a kind of bench of around 100 plus associates. As a result, we have incurred an additional cost of 2.25 crore. Our selection business saw a decline of 30%. This business has a fixed cost. It is registered disproportionate to the EBITDA decline. While we expect a part of volume decline to last till Q4, we expect certain percentage, around 20 to 30% of volume recovery to happen in Q3 on a run rate basis. Regarding 3 crore provision in training and skill development business, while during normal course of business, we used to backfill the student who used to drop out, we now decided to stop these in accordance to our decision to wind down this business. We expect this cost to be minimal going forward. We have invested 4 crore in Q2 towards building our presence in United States. International business contribute almost about 25 crore EBITDA this quarter. This has given us confidence to enter into the largest staffing market in the world. This helps us to achieve and sustain a high margin organic growth. We expect to achieve a break-even in this business by Q1 FY24. Viewed by record headcount additions, we are now focused on improving our margins in this segment. Moving on to our Global Technology Solutions platform. The segment continues to show impressive growth, revenue growing at 23% and 4% quarter-on-quarter, while EBITDA grew by 9% year-on-year and 2% quarter-on-quarter. Customer lifecycle segment continues to grow at 20% plus growth rate, driven by 36% growth rate in international CLM business. Both Connect and Allsec had impressive revenue growth and achieved highest ever revenue during the quarter. We have made several business model innovations in CLM, resulting in doubling our order book to about 230 crore in H1 compared to 110 crore in H1 FY22. In the non-voice BPO, our collection business had a very good Q2, resulting in 23% year-on-year growth. This is a good example of solution-centric approach resulting in platformization of our collection business using digital tools. In platform-based services, our North American business under MFX grew by 8% quarter-on-quarter. HRO platform business, ALSAC, added 100,000 new payslips during the quarter and leading to 15% growth year-on-year. Moving on to integrated asset management business. This business registered a robust top line of about 33% year-on-year and 9% quarter-on-quarter. Integrated facility management saw a revenue growth of 33% year-on-year and 10% quarter-on-quarter. During the quarter, we saw our muted sector like IT, ITES, and education coming back to an extent, while our focus sector are seen to be continuous in demand. The business added 36 new logos during the quarter. IT segment witnessed a marginal recovery on return back to work and grew by 15% quarter-on-quarter. Number of meals served have also picked up, registering a 5% growth quarter-on-quarter. This has resulted in 26% quarter-on-quarter increase in Q2. Our facility management business have launched an application named QBridge, which facilitates real-time project management leading to integrated facility management monitoring, significantly improving the efficiency of operations and monitoring the service level delivered to customer. This has resulted in improvement in core to associate ratio to 95 from 91 in Q1. We expect QBridge to fully manage all aspects of our service level deliveries by Q1 FY24, which will lead to higher efficiency and better customer engagement. Security business grew by 28% year-on-year on back of strong headcount up by 25%. Customer sales momentum remains strong with 21 new customers in the quarter. Our telecom business, Vedang, grew by 38% year-on-year on back of increased demand from telecom segment and upcoming 5G rollout. Let's move on to our product business, where we continue to make significant progress. Monster continued to log impressive number with sales revenue growing up by 37% and 40% year-on-year respectively. New user acquisition was at highest ever with 1.8 million registrations in Q2. The candidate traffic and engagement saw a spurt with 6-month active candidate base grew to 17.3 million and traffic on the platform growing by 25% quarter-on-quarter and crossing 44 million. Strong customer acquisition continued with more than 2,700 new contracts signed. The customer feedback continues to be positive as the business achieved CSAT and NPS scores of 90% and 20 respectively. Zuno Fellowship, which was launched in July, saw more than 130K candidates registering for fellowship test. Coming to blue collar job platform, we have started exploring the options towards monetizing our products. QJob saw an external customer count reaching to 7,900, increase year-on-year. The new jobs opening hosted on platform increased by 122% year-on-year to 2 million. The NPS continues to be among the best in the industry. The cash burn in this segment is as per our expected in line with prior, as we have communicated in past, we are in line. Our corporate cost has gone up by 8% quarter-on-quarter, driven by higher salary cost, increased spend on travel and tools and tech. While we continue to invest in automation and other technology to drive our processes, we are simultaneously looking very closely at our cost structure to identify opportunity for reduction. Coming on to the corporate updates, we have completed divestment of Simpliance. The transaction valued Simpliance at enterprise value of 120 crores against our original investment of 4.5 crore for a 53% stake in the company. This transaction validates our ability to nurture and turn around the tech-based business. In line with our capital allocation policy, we have announced an interim dividend of rupees 8 per share for FY23. This reflects our confidence in cash generation ability of our businesses. So far, that was the overview. Going forward, our focus continues to be on A, addition of headcount, B, driving sales and cost optimization to improve margins. We thank you, the analyst community, as it is your support and our institution has a primary focus. We will continue to grow, focus on margin. Certain reinforcement just before I conclude. Strength of our business model in GTS holding up where there is a weakness in other sectors. Simplest divestment as part of our outcome of capital allocation policy and our long-term orientation, we hope to see more such portfolio rebalancing projects in future. Greater growth than competition in general staffing. Dividend payout is a reflection of our confidence in cash generation. Investment in technology and organic growth will continue. Stability and focus on ROE and market share are our key priorities. So with that, now I hand over to Ravi to talk about financial matters.
Thank you, Guru, and good afternoon, everybody. Despite putting the pandemic behind us and powering on, global uncertainties continue to provide some challenges in the business environment, which is evidenced largely through a slowdown in IT hiring that has impacted our IT staffing and selection businesses. However, this quarter also highlighted the intrinsic strength of our business model as our GTS vertical held up even when there is a general weakness in the operating environment, especially the specialist staffing businesses. Let me now walk you through the financial performance of the company. Our overall revenue in Q2 grew by 7% compared to the previous quarter and grew by 32% on a year-on-year basis. All the segments posted healthy top-line growth with Workforce Management, GTS, Global Tech Solutions, Operating Asset Management, and Product-Led Business Platforms growing by 33%, and 62% respectively on a year-on-year basis. Our EBITDA from operations in Q2 FY23 in absolute terms improved by 20% on a year-on-year basis to 135 crore rupees. EBITDA margins have declined by 32% year-on-year and 70% quarter-on-quarter to 3.16%, largely due to the following reasons. Workforce Management has been impacted by 13 crores due to a slowdown in the IT staffing and selection business, and 4 crores towards the newly set up North American professional staffing business. Operating Asset Management saw an additional inventory cost of 3 crores in the food business. Our SG&A costs were also up by about 5 crores, largely on account of salaries, travel, and tech implementation costs. I would like to now move on to segment-wise updates. Let's start with Workforce Management. Workforce Management as a segment, the revenue grew by about 7% on a quarter-on-quarter basis and 33% on a year-on-year basis, driven by general staffing and the Singapore business. General staffing business grew by 8% quarter-on-quarter and 36% on a year-on-year basis, while Comtel Singapore grew by 11% quarter-on-quarter and 48% on a year-on-year basis. We have already spoken about the reasons for EBITDA decline in Workforce Management. However, I would like to add that we have already started to see the part of business coming back and expect margin improvement in the coming quarters. Global Technology Solutions. This segment has shown a 4% revenue growth on a quarter-on-quarter, driven by MFX and Connect, which grew by 18% and 3% on a quarter-on-quarter respectively. The year-on-year growth of 23% was also driven chiefly by Connect, by the Connect business. EBITDA for the segment grew by 2% on a quarter-on-quarter and 8% on a year-on-year basis. driven mainly by the InsurTech platform and the Allsec business. There has been a slight margin dip in this vertical due to expenses incurred in bolstering the tech capability of our businesses. Operating asset management. Revenues have increased by 33% year-on-year and 9% quarter-on-quarter, driven by our facility management, security, and telecom service business. EBITDA saw a decline of 7% quarter-on-quarter due to an additional inventory cost in food business and some additional costs in the industrial asset management segment. Our continuous efforts in collections has resulted in a much better working capital management and has been instrumental in bringing back our OCF to EBITDA to over 70% in Q2. As a result, we have reached a net cash position of 57 crores in Q2 versus a net debt position of 59 crores in Q1. I would like to now touch upon depreciation and interest costs. Depreciation increase of 7 crores quarter-on-quarter is predominantly on account of Ind AS adjustments on leased premises and equipments for the GTS business, which is Connect. The operating depreciation continued to be around 31 crores and increased only by about a crore in Q2. We continue to maintain our annual capex run rate of 80 to 90 crores as communicated earlier. Similarly, interest cost increase of 6 crores can be divided into two parts. 3 crores of increase has been on account of rising interest rates. As a result, our interest outflow has increased from 12 crores in Q1 to 15 crores in Q2. The remaining or balance increase has been on account of Ind AS adjustments towards lease premises, as explained earlier, which is for Connect. Balance sheet and corporate actions. We continue to acutely focus on collections, and this has resulted in our overall DSO reducing by 1 day quarter-on-quarter to 58 days. In line with our policy of capital allocation, we have announced an interim dividend of 8 rupees per share for FY23. This truly reflects our confidence in the prospects of the cash generation abilities of all our businesses. We continue to focus on corporate simplification, and you will hear from us more about this as and when we are ready with news on this front. Lastly, on taxation, there has been no significant updates regarding the ongoing income tax matter. The special audit that was ordered by the tax authorities for the financial year 18-19 has also been completed, and the draft assessment order is expected shortly. We believe the draft assessment order would be on lines similar to what we had received for the previous year. Once again, we would like to thank you all for your continued support, and I would like to now open the floor for questions. Thank you again.
Thank you. Ladies and gentlemen, we will now begin with the question and answer session. Anyone wishing to ask a question may please press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is on the line of Nitin Padmanabhan from Investec. Please go ahead.
Everyone, and congrats on the strong revenue performance. I had a question on the operating expenses. So there's this line item, cost of materials, stores, and spare parts. So that's up. That's been growing at a 22% CAGR since Q1 FY22, and it's now at 129 crores. Even this quarter, it's like a 0.5% sort of impact on margin. So just want to understand how we should look at this number, what's the context behind this number, and what's driving such a massive growth on this cost line.
Sure. Thanks, Nitin. This is Guru here. And largely, this particular line item refers to a business that we are into, a break fix business, where, between April to October is a peak time for this business, and the inventory management of that is what is driving the cost of material in this largely. That's the majority contribution. Cyclically, this business has a peak between April to October, then Q3 it slightly tapers back and then regains again thereafter. So that's how this business operates. So that's the cost which you are seeing there.
Yeah, but the only reason I pointed it out is it's possibly the highest number we have ever seen. And although I understand the cyclicality, the intensity is only increasing. So the intensity of the expense. So I was just wondering, is there a commensurate revenue addition with a margin on top, or how should we think about this number at all? And does this really have a bearing on margin in reality?
Absolutely, Nitin. You're absolutely right. This cost is directly linked to our revenues and margins in QDG business, and so there's absolutely and it's not a cost that's actually that we're incurring separately.
Sure, fair enough. And just if I may, just another broad question on the demand environment. So if you could just give some color on the general staffing business, how do you see that for the second half? And generally within that, even the IT staffing business, do you expect declines on that side of the business? Those were the two questions. Thank you.
Lohit, you want to take this?
Yeah, thank you, Guru. Nitin, good afternoon. This is Lohit here. Thank you for your question. And if you notice, in the first half of the year, our general staffing team in India has added close to 53,000 net adds. In the last 12 months has been our best ever. And in fact, this 6 months also, we've added in the last 12 months about 81,000 net adds. The reason I give these numbers out while you've already said it's a good performance is because in an ordinary year, we used to do our best year, not ordinary year, but ordinarily best year, we used to do about 50,000 plus in 12 months, which our team has been able to achieve in 6 months. Couple of points if you remember from the last few quarters call. One, we said we doubled down on our sales initiative in this entire business. We doubled our sales, and yes, we incurred some cost bringing in the sales resources. Second, we focused on M&I and M&A. Manufacturing and industries, if you notice, used to be ranking 6th and 7th segment for our business. It has inched up to the 4th place, the 4th segment in our business after BFSI, retail, telecom, and now manufacturing. Telecom and manufacturing now at Quess General Staffing are neck and neck with each other, both at about 50,000 associates each. So that's the second point which we focused on. The third, as far as the demand environment that you're talking about, our sourcing team has started run rating at an average between 7,000 to 10,000 people sourced every month. And that's a capacity again that we've added, both in terms of digital capacity from QJobs and the other platforms that we've brought in the last 12 months, but also from the recruiters. I must also add, if you've obviously heard that we've crossed the 500,000 mark, but if you split our data in that 500,000, you would see that Tier 3 today contributes nearly 1/3 of the deployment in the country. So with Quess, the kind of size of operations and branches that we have, the kind of technology we have, the sourcing that we have, we definitely feel that this would be something that we would be able to replicate. To your very specific point on what would happen after the Diwali season is over, yes, there is some amount of destocking or reduction of the people hired interimly only for the season. In this number, our estimate is about 6,000 only are those numbers. So this number does not contribute more than 25% of such resources which were hired for a short-term duration.
Just to add, Nitin, the data is quite inspiring to see the way it is, the distribution between cities are panning out. So we were just doing our own internal research on this, and it's good to see that kind of distribution between Tier 1, Tier 2, Tier 3 for us is almost equal, which means about 35% Tier 1 and more demand coming from Tier 2 and Tier 3 kind of cities. So that's it, just a data point.
Sure, perfect, Lohit and Guru. Thank you so much for this. All the best.
Thank you.
Thank you.
Thank you. The next question is on the line of Jitendra Arora from ICICI Prudential. Please go ahead.
Hi, team. Thanks a lot for this opportunity. I have a couple of questions. Given that we have clearly laid out that we are targeting a particular ROE and also a 6% EBITDA by 2025. Now, if you see last quarter, there were certain issues because of which the EBITDA was where it was. This quarter again, I see the EBITDA margin is at 3.2%. So I just want to understand from the team, how do we see ourselves from the current 3.2% to reaching that target of 6% by 2025? Is that simply aspirational, or do we believe that there is a glide path to it?
Okay. So, Jitendra, thanks for bringing this. So, first and foremost, it's definitely a goal and aspirational number that we are
So, Guru, in that case, may I ask, what is the more realistic number that, as investors, we should keep in mind?
I'll bridge that. So let me give you certain what thinking goes behind putting up a number like this. So first and foremost, when we entered this financial year, it was little unforeseen the way the turns that happened. Probably a couple of investments that we had planned. When we did that initial planning, Monster fundraising was not in our roadmap at that point in time because the product was still under construction and we still had not reached a situation to raise the capital there. So, and PCPL is another product which is doing really well, and there is a good traction from the investment community in that product, in the product-led business. So, with this not completely anticipated into the plan, we would have definitely reached to where we have committed. But however, if you look at considering the kind of burn that we are looking into, the investment that we have raised, by FY24, we firmly believe that we are on the course to reduce the burn and start, the moment we start reducing the burn by FY24, as per the plan that we have, we are still confident that, we can slowly graduate towards that direction. Having said that, there are a couple of other businesses which are turning around. For example, our entire asset management business, which used to deliver an EBITDA of 8%. Now where we are is about say 4.5%. Now there is a solid growth trajectory in this business, and this business was genuinely down for last 2 years. And as and when the market is opening now, we are already seeing 15% growth in ITITS slowly coming back. Plus, our focus on growth in this business, going aggressively on sales, we are confident to bring this, get this back to the trajectory, which will be accretive to our margin. Number 3, our international businesses which are delivering well today, out of total EBITDA what we generate, on an annualized basis, roughly 100 crore comes from our international business, which constitutes to about 7,000 by headcount. With the new investments in America, US that we are currently doing and setting up the platform for future revenues, and these businesses come at a high margin over a period of time, right? So the product mix is something that will drive the margin increase for us over a period of time. However, we cannot stop our general staffing growth. We are number one. We'll continue to grow, and they don't grow at the kind of margin that we anticipate. So they have an ability to deliver anywhere between 700 to 750. So with more operational efficiency coming into and more growth oriented on our other 2 platforms, plus product-led business turning into by FY24, I'm sure we are still confident that we will march towards that direction.
So, thanks, Guru. But the thing is that as an investor, when you guide for a particular margin or for a particular kind of business performance, it is assumed that management has taken into account some of the roadblocks that it will potentially face on the way, and hence has been a little bit of conservative in terms of their guidance. Unfortunately, I don't get that sense right now when I heard from you.
Our plan in line to what we are doing, we are definitely mindful about the direction that we are going into, but however, we are constantly, recalibrating and going back to the drawing board. So we'll come back and let you know at a point.
Yes. So in that case, I'll appreciate if we can get a more realistic sense of where we can be, perhaps. I'll really appreciate that.
Sure, Jitendra.
Thank you.
Thank you. The next question is on the line of Vidit from IIFL Securities. Please go ahead.
Hi, thanks for taking my question. My first question was, this 13 crore impact on IT staffing and selection. If you could delve a bit into it and, give some further insights. Assuming we do somewhere around 1.7, 1.6% in general staffing, it appears IT staffing margins have really halved, versus the previous quarter. And that would imply that our fixed costs in this business is extremely high, which is typically not the case. So, if you could, somewhat explain this 13 crore impact would be very helpful.
Hi, good afternoon, Vidit. This is Lohit. I'll take that. So first and foremost, before I go into your specific question and walk you through the margin profile and what's happened Q on Q, I must just call it out that our IT staffing and permanent recruitment team has done a fabulous job in the last 3-year period. If you look at us in a 3 to 4 year period, pre-COVID, during COVID and today, we are at triple of our EBITDA from this business on an H1 basis this year in comparison to H1 of 21, and we are double of our EBITDA from H1 of 19 and H1 of 20. So that's number one. I wanted to clearly call it out. IT has been a strategy that we feel we will play. We are one of the largest players there, both in permanent as well as temporary staffing, and we will continue to play in that space. That's point number one. Point number two, now what has happened between Q1 and Q2? So a couple of things have happened. One, you must also be seeing all the IT news coming across the world and from the IT services companies in India as well. As the wage inflation in the last 12 to 18 months really went up, the supply side and the demand side both started having a wage inflation, which means customers' POs also went up. Simultaneously, associates' compensation and salaries also went up. In the last 4 to 6 months, a lot of companies have become extremely conscious on margins, which means that the customer's pressure on revenues and PO line became faster than you can convert the cost. So cost takes a lag of about 1 to 2 quarters before you can start rebalancing the cost itself. That's the first thing which has happened in this business, and which is where Guru in his speech itself had mentioned, and so did Ravi, that 7 crore of impact has come from that side of the business. The second important thing here is we are fairly large with 100 plus crore revenue line from our permanent IT practice. This practice from a Q on Q basis has come down by almost 40%. Our fitments in Q1 were close to 3,300 onboards to customers, which has shrunk to 2,200 and below. Now, 2 reasons have happened. One, obviously, like I said, customers have become a little margin conscious, and hence onboardings have either been deferred or the number of open mandates on which we were working in our RPOs have kind of come down. What would happen going forward? Now, we are seeing Q3 would be the ebb from where we would start to rise again. And in Q3, there are 2 actions which we are taking. One, obviously on the cost side, wherever we had niche skills, but the niche skills have not been deployed to customers, will be relooked at. They will be rebadged or moved in other projects. The second thing what we would look at is renegotiation of contracts where we can. And the third, obviously, what we would be looking at is getting more demand back on the basis. Where do I see it on 10th of November? In the last 40 days, we see some of that demand has started to rise again. We've also moved some segment outside of the IT and ITES to give a little bit of a flavor. So that's where it is as far as the IT ITES is concerned, and which is why only from a pure quarter-to-quarter perspective, when you look at it, you would see the pain. But if you compare this half of the year with any of the half of the years in the past, it has been still a very, very phenomenal result, and we'll continue to be a big player in this industry.
Got it. So, I mean, like with the 2-quarter lag for cost optimization, we'd expect it to be back to 1Q levels, by 4Q and after.
Yes, very good assessment. Absolutely.
Okay, got it. And my second question was on the, the investments made in US staffing. I mean, if you could shed some light on the sort of market share that we have out there, and whether this, 4 crores of investment that is being made, is it enough for really, kickstarting high growth momentum out there, or are we going to require continuous investments to really capture that market?
I think it's a brilliant question, and thank you for asking that. So first and foremost, I think Guru answered it both in his opening speech and then also when the question came that how do we go to the glide path of 6% EBITDA sometime into the future. Let me give you a little bit of a color of the US market and what prompted us to get there. The United States market has $160 billion of staffing growing at about 8% per annum. US is adding one Indian staffing every year. So while India is definitely growing at 25-30%, Indian Staffing Federation's last number shows 21% plus, and we assume that the market will continue to grow at that space, and we are obviously growing faster than the market in India. US is adding one Indian staffing every year as a market itself. That's number one. Number two, India has about 5 to 5.5 million IT staff deployed in our country. At the same time, USA is the only other country in the world which has as many and more people deployed in IT as well. So it's a very large market out there. Currently, what we do in the United States and Canada for the last couple of years is through MFX and our InsurTech business, which comes under our GTS platform. Staffing hasn't really done anything in the last couple of years, and we wanted to be strong in both India and APAC to be at the right time to make that conscious call to go to US. Third, to your question that how does this start to pan out? This 4 crores is an investment towards registering the legal entity in Delaware. It's for all the taxation requirements and the paperwork that we've done to hire the leadership team that we've already hired. Going forward, we feel that on quarter-on-quarter basis, this 4 crore number would start to taper downwards. Somewhere by the exit of this financial year and the early entry into the next financial year, we would be at a situation of break-even as far as the US staffing business under WFM itself is concerned. Last point I want to leave you with, not only is it the largest market in the world, it operates at a 6 to 8% and above EBITDA margin as well. And with where the US dollar to Indian rupee is, I am sure you'll understand that at some point of time, this will play out in the medium to long term for Quess overall.
Okay, understand. Just one follow-up to that would be, I mean, what is the differentiating factor that, Quess is going to offer versus the existing players in that particular market that can, make customers move?
Yes.
Or are you just targeting new customers?
We would, the short answer to that is we'll be targeting both. There are new customers coming up as well as their existing customers. Second, US has on last count a shortage of about 1 million IT workers, and customers are looking for new companies who have innovative technology solutions and deployment and sourcing capabilities on the basis of which orders can be given. Let us not forget, we control 1,700 recruiters in the Indian geography itself. We are the largest recruitment factory, and we have a huge ODC that can be created in India in practically no time. We also have 500 of those 1,700 recruiters in IT, so we understand that space very well. We also have a fairly decent business in Philippines. So if you kick in the back end from Philippines and India as an ODC for sourcing and deployment with the customers front-ended from the United States of America, you can definitely imagine that we could get some of that $160 billion space. Today, WFM is over the $1 billion, $1.5 billion mark. We obviously need to add the next $1.5 billion at much higher margins from another geography as well. So we are pretty confident that what Quess has been able to create in 15 years, both with its delivery as well as its technology capability, customers in USA are also having very, very decent conversations with us. Anecdotally, let me tell you, from whatever conversations I have personally done with customers and met with them, they have been shocked by seeing the POP onboarding tool that Quess has created, the workforce productivity tool called Work, and the Q Jobs. And many of the companies, and with due respects to all my international competitors as well, who've been in business for 70 years or more, many of them have not created technologies like this, which in a market like India, obviously Quess has created.
Okay, understood. Thanks for these clear answers, and good luck.
Thank you. The next question is on the line of Nikhil Gada from Abacus AMC. Please go ahead.
Hi, sir. Thanks for the opportunity. So, sir, when you explained about the IT staffing part, and while you say that it might take a couple of quarters to get our cost optimization done and maybe even see improvement in the business, so then what kind of EBITDA margins do we expect in the WFM for the second half of FY23?
So WFM, in all likelihood, in our understanding and our internal homework, is at its lowest that it could be. We've baked in Q2 whatever cost we had to incur, whether it is for IT staffing, whether it's the temporary slowdown that we saw in RPO or permanent, as I just spoke about, whether it is our investments in US and in technology. So all these are already baked into the numbers. You can take these as bottoms as far as the WFM is concerned, and we can, with our growth both in India and outside of India, and Ravi alluded in his presentation where he spoke about the fact that how phenomenally the asset that we acquired a few years ago in Singapore is doing today, and it's grown over 40% in EBITDA year-on-year basis. So going forward, we definitely want to first inch back to a 3.4-3.5% EBITDA margins. Thereafter, to gradually get to the aspirational 4% mark from this asset, for the rest of the Quess to also inch equally upwards.
And to reach this 3.4%, back to this 3.4% margins, how many quarters do you think would it take?
Nikhil, in the WFM business, as you understand, the largest, the 80-pound gorilla in the room is the staffing business. It's a 2% EBITDA margin business. If some of the other elements, like on the last call, I remember I had mentioned that the general staffing business, while growing 25-30% year on year, was contributing only 45% to the overall mix. So if general staffing continues to grow, but others disproportionately grow faster than general staffing, and US also starts to join the party, this will move up much faster than all of us can expect. So there are a couple of moving parts. You can understand my challenge here by giving a specific date or a specific month, but I'm not saying this is going to take years. That's a promise.
But the question is, Nikhil, are we working in that direction to get the right product mix? The answer is yes. So we are doing everything to see how we can gradually move, whether it is one-way investment and the new product line international and other geographies delivering a higher EBITDA margins, IT staffing, of course, reviving back, and even cost reduction and etc. So we are definitely working on every other parameter to get to that direction.
Understood, sir. And sir, secondly, regarding the OAM business, you mentioned there was a 3 crore write-off because of inventory. Is that the only reason the margins have fallen further from 5% in 1Q to around 4.5% in 2Q?
No, it is. See, there is. It's not a. It's a one-time, Q2 impact that we have taken in one of our businesses. So, it will not recur back in Q3. So we should. The business definitely has a potential to revive back to its EBITDA margins in coming quarters.
Any sort of a guidance you would say, because I think last time you mentioned that 5% is the absolute low that we might hit in the OAM business.
So yeah, of course it will be close to 5%, anywhere between 4.8 to 5%. It definitely has the potential in next 2 quarters to get back to those levels.
Okay, got it. And so just I did not understand the Ind AS adjustment for the depreciation and the interest part for Connect business. If you can be more specific as in what the changes have been.
Sure. So Nikhil, basically, your lease assets you have your depreciation, you calculate a certain interest component, and you kind of amortize the rentals over the future lease period, right? That's what I meant by saying that there are two components to the interest and to the depreciation and amortization. One, the facilities that you have taken on rent gets amortized along with the interest part of it, actually. So, and that's what I meant by saying that there are two components. One is the lease, the interest on lease, and second is the depreciation itself.
So then this sort of the run rate that we are seeing now in depreciation and interest, that is something which we expect to continue, right?
Yeah, the one on depreciation will continue. As our borrowings keep coming down, the financial interest cost will start coming down too.
Understood. Got it, sir. I'll come back in the view. Thank you.
Sure. Yeah.
Thank you. Reminder to the participants to ask a question. You may please press star and 1 on your touchtone telephone. The next question is from the line of Sanjay, an individual investor. Please go ahead.
Hello. Yeah, there was a good increase in business in Monster, and just want to check about what are your plans to capitalize this Monster investment? Are you planning to divest it, planning to separate it out, or bring it to the public? Any plans you're having it on Monster?
Yeah. Hi, Sanjay. Yeah, we've been having a couple of great years at Monster, growing very rapidly, and more importantly, the product metrics, which is around engagement with recruiters and candidates, has been growing very, very fast. There is still a huge growth journey ahead for Monster. We are adequately capitalized. As you know, we raised capital just in the January earlier this year. We expect the current growth to continue at least for the next 3-4 years. There is so much headroom to grow, and we're excited about the product lineup. And when we do that, all options are possible. There is enough and more investor interest still in it, private investor interest. But at the same time, the way the business model works, as business model, once it starts turning profitable, the margins are significantly higher. And we have enough examples of some great publicly listed companies in this model. So all options are on the table. Right now, we're focusing on doing the right things for the business. We're growing fast, and we're doing the right things from the product.
Thank you.
Thank you. Participants, if you have a question, you may please press star and 1 on your touchtone telephone. The next question is from the line of Mukul Garg from Motilal Oswal Financial Services. Please go ahead.
Yeah, hi. Thanks for taking my question, and I hope I'm audible. My question, I just had 2 follow-up questions to Lohit on the US market expansion. I'm assuming that this will be staffed purely from local resources, and wanted to understand it a bit better. If you look at the US market till now, it has been a extremely supply constrained market, and that was the reason why there are so many openings which are there in the local economy. So how are you going to kind of bridge this gap in terms of supply which is there, which again your local peers have struggled quite a lot to do it? Do you think there is some local know-how or technological advantage which you can bring to the table? And B, as the macroeconomic environment slows down there, and as this kind of moves from a deficient to an environment where the ability to staff projects kind of gets impacted because of lack of demand, how should we think about the glide path to profitability over the next 3 quarters? Is that something which you have factored into the estimates?
Sure, Mukul. Lohit here, and thanks for the question. So first and foremost, you're right. In the US market, there are 2 ways that you can play the market. There are local candidates, and there's the immigration policy business as well that you can do. At some stage, given Quess's size, scale, stature, and ability to move talent across geographies as well, as we've been very successfully been able to do that in the last 5 to 6 years between India, Middle East, India, APAC and other geographies. We should be able to play in that game as well. However, our current numbers are not based, or our current calculations and entry into the US market is not based on a visa strategy or an immigration strategy. What it is based on is that there is 100,000 people who have probably been let go, and there is 1 million people in the IT space where there is an open mandate. In the US also, you would see, just like in India, there are 2 categories of people who are getting hired in IT. There are the niche skills, where we can definitely play a lot, and there are the perennial skills. Perennial skills are the ones where companies would offload people when the times are slightly tough, and we've been hearing some news of that as well. It allows our recruiters to onboard those people quicker because they're already onshore in America, and they can be moved from assignment A to assignment B, whether they are on an H-1B visa or whether they are on any other status there. However, in the niche segment also is something that we've already started playing, and this is something which both for APAC as well as India, our teams have been very successfully doing. So when I was mentioning the 1700 recruiters on an average in India, out of which 500 are tenured recruiters and in the IT space at Quess in India, there are another 200 recruiters which are in APAC and in Middle East who also understand the space very well. So a lot of coordination across hundreds of our IT customers from APAC, Middle East and India, and a lot of coordination across the hundreds of recruiters that we have. You just couple that with technology advancement that we do. Now, I'll just leave one thought with you, how technology makes this whole differentiation. Today, if you call up most of the staffing companies in the US, they'll tell you that they still use UPS to onboard a candidate. It takes anywhere between 30-35 days for the papers to go and the papers to be returned back and a candidate to be successfully finally onboarded. You know it, Quess has 6,350 towns and cities and villages where people are deployed, and our POP works within 7.5 to 8 minutes to onboard a candidate. So just think about it. If tomorrow Quess were to stand in the same market and tell people that what could earlier be done in 30 to 35 days, but we could crunch the time down to 8 minutes, instead of it taking $50 or $100 to onboard a person using UPS, but we could do it in a matter of $1 to $5 using our technology, I don't need to explain further as to what are the opportunities available in the market.
Just to add, Mukul, these technology we are not first time testing in US. We have already tested in our APAC geographies, and we are prepared to take this out. So that's just an addition.
I understand that, Guru and Lohit, and pardon me for following up on this. I understand, in APAC and India, this has worked quite well. But when I look at the US market and specifically the technology space, it has been a fairly penetrated, I would say, overabused space. And you have, technology companies who are all over the place there. Now, when I'm looking at the market right now, it is, as Lohit correctly highlighted, it's a market where there's a lot of supply which is coming in as companies shed employees. When I look at your aspiration to turn profitable by Q1 FY24, is that something which can get delayed because there is I would say little demand for scale up over next 3 quarters and can kind of play out, but maybe a little bit longer time horizon.
You're right. The market has been, the US market staffing is not new. There are operators who've been operating for 70 years and more. Yet in the last 5 years, a lot of smaller firms have created a niche for themselves and built up practices anywhere between $50 million US to about $300 million US. And I'm not talking about any of the listed companies. The second point is that the active conversations in the last 3 to 4 months that we've had with customers spread across permanent staffing, RPO, as well as contract staffing. And many of these customers are currently already using homegrown US firms, yet they are in talks with us to have Quess impaneled and onboarded as a partner. So, Mukul, I definitely take your feedback, and we will keep all these points that you've raised in our mind, in our deliberations with our teams, and we will ensure that, this is not just another strategy to add a flag in another geography, but it significantly adds to the bottom line at Quess.
I appreciate that, Lohit, and thanks a lot for answering my question.
Thank you.
Thank you.
Ladies and gentlemen, this was the last question for today. I now hand the conference over to the management for closing comments. Over to you, sir.
Thank you. Thanks for everyone. I think it was quite engaging conversation. So I take this opportunity to thank analysts and investors and the community. It's your support to us and the kind of support that we get from you and the insights for our institution. We'll continue to focus. Our primary focus is going to be on growth and margin. So we'll not take our eyes off. We'll continue to drive and stay ahead in the market. Thank you so much.
Thank you. Ladies and gentlemen, on behalf of ICICI Securities Limited, that concludes this conference call. Thank you for joining us, and you may now disconnect.